Gas prices did something in March they have not done since 1966. They jumped 21% in a single month. That one number accounts for nearly 3/4 of the entire consumer price index increase, and it dragged headline inflation to 3.3% year-over-year, the highest reading since April 2024. The mechanism was direct. U.S. strikes on Iran in late February disrupted tanker traffic through the Strait of Hormuz, the choke point that handles roughly 20% of global oil shipments. Less oil moving meant higher prices at the pump, almost immediately. The BLS reported the full CPI print at 0.9% for the month, the largest monthly jump in 4 years. But strip out energy and food, and core CPI came in at just 0.2% monthly and 2.6% annually, both a tenth below forecast. Wall Street exhaled. Services inflation, shelter, medical care, all tame. The tension that matters, headline and core, are telling opposite stories, and the Federal Reserve has to decide which one to believe. Fed officials have been clear in recent days that they are not ready to cut. San Francisco Fed President Mary Daly put it plainly. An oil shock means getting inflation down simply takes longer. Prediction markets now put the probability of zero rate cuts in 2026 at roughly 40%, the single most likely outcome. The ceasefire between the U.S. and Iran, announced April 7, has already started pulling energy prices back. But Goldman Sachs Asset Management's Alexandra Wilson Elizondo warned that the Fed needs more than 1 month of moderation before it can declare victory. Energy prices would need to stay elevated for a full quarter before they start feeding into core services, and the March CPI only captured the first month of that shock. The University of Michigan's Consumer Sentiment Index told a different story entirely. It fell to 47.6 in April, a record low, down more than 10% in a single month. One-year inflation expectations jumped to 4.8%. Survey Director Joanne HSU noted that most interviews were completed before the ceasefire, so the reading largely reflects March's fear, not April's relief. If the ceasefire holds and energy stays lower in April, the next CPI print could look dramatically different. If the Hormuz situation deteriorates, Iran is now reportedly demanding crypto-denominated tolls from passing tankers, with the Revolutionary Guard charging up to $2 million per vessel since mid-March. Energy prices could re-accelerate and pull core inflation up with them over the coming months. While inflation dominated the macro conversation, the AI infrastructure build-out produced 2 deals in 2 days that reshaped the data center investment thesis. On Thursday, Meta committed an additional $21 billion to CoreWeave, stacked on top of a prior $14.2 billion pledge from September, bringing the total commitment to $35.2 billion from a single customer. On Friday, Anthropic signed a multi-year agreement to run its Claude models on CoreWeave's platform, and CoreWeave's stock jumped 13%. The company now counts 9 of the top 10 foundational AI model providers as customers. The only holdout is xAI. CoreWeave's business model is simple in concept and expensive in execution. Rent NVIDIA GPUs to AI companies that cannot build fast enough on their own. The company holds $21 billion in debt, and just added $8.5 billion more in March to fund new infrastructure. To finance the Meta deal, it raised another $3 billion. CEO Mike Intrator was direct on CNBC Friday. Scaling is expensive, and the company is deliberately taking on leverage to capture what it calls a generational opportunity. Anthropic's own numbers give that framing credibility. The company reported an annual revenue run rate of $30 billion in April, up from $9 billion just 4 months earlier. AWS, Amazon's cloud arm, reported an AI revenue run rate already above $15 billion in the first quarter, growing so fast that capacity constraints, not demand, are the binding limit. Amazon CEO Andy Jassy told shareholders the company has never seen a technology adopted more quickly than AI, and compared its trajectory to electricity, but moving 10 times faster. NVIDIA sits at the center of this supply chain. Its stock extended a 7-day winning streak Friday, and CEO Jensen Huang told GTC attendees in March that combined sales of its Blackwell and Vera Rubin GPU lines could reach $1 trillion through 2027. TSMC, which fabricates the chips, reported strong March sales that confirmed AI demand shows no sign of slowing. Meta's own AI story has an additional layer. Its stock fell 5% year-to-date going into this week, weighed down by back-to-back jury verdicts on child safety, a $375 million penalty in New Mexico, and congressional pressure on AI data center construction. The launch of Muse Spark, its first frontier model from the newly formed Superintelligence Labs, pushed the stock up 6.5% in a single session Wednesday and added $143 billion in market cap across 5 trading days. Evercore analyst Mark Mahaney maintained a $900 price target and called the stock dislocated, trading near its 3-year trough multiple at 18 times forward earnings. The tension connecting these two chapters is real. The same Iran conflict that sent inflation to a 2-year high is also the force that has suppressed sentiment, compressed multiples, and potentially left AI infrastructure stocks cheaper than the underlying demand warrants. The next 4 to 6 weeks will determine whether the current market configuration, tame core inflation, record low sentiment, surging AI capex, resolves into a recovery or deteriorates into stagflation. The ceasefire is the single most important variable. If the April 7 agreement holds, and Hormuz toll enforcement remains limited or informal, April's energy prices will likely be meaningfully lower than March's. That would give the Fed permission to hold without hiking, keep the door open for a late-year cut, and allow consumer confidence to recover as gas prices fall at the pump. Bond traders are already pricing one cut before year-end, though the probability is below 50%. The weight of evidence leans toward the Fed holding steady through mid-year and waiting for 2 more clean CPI prints before adjusting. But this only holds if the ceasefire is durable. Iran's parliament has formally proposed crypto-denominated Hormuz tolls, and the Islamic Revolutionary Guard Corps has been charging individual vessels up to $2 million since mid-March. If toll enforcement becomes systematic, tanker traffic through the strait, already running at a fraction of pre-war levels, could remain constrained. That would keep energy prices elevated, begin feeding into core services by May or June, and close the window on rate cuts entirely. On the AI side, the demand signals are unambiguous. CoreWeave's back-to-back mega deals, Anthropic's $30 billion run rate, and NVIDIA's winning streak all point to an infrastructure build-out that is accelerating, not plateauing. The risk is not demand. It is leverage. CoreWeave now carries nearly $30 billion in debt, and the viability of that structure depends on long-term contracts continuing to flow. The 2 benchmarks to watch. First, the April CPI release. If gasoline retreats and core holds below 2.7%, the Fed hold narrative stays intact. Second, Hormuz tanker traffic data in the second week of April. Any resumption of normal throughput would be the clearest sign that the inflation shock is behind us. If instead the tolls formalize and tanker volumes stay depressed, the March CPI will look like a preview, not a peak.